Hey everybody, welcome to this free edition of our Trader User Group. This is for the trading week ending December the 8th, 2023. I'm Preston Bryn. Thanks for tuning in, everybody. Well, this week's theme is going to be the key to how we finish out the last few weeks of 2023. That'll be the Fed dot plot. That's going to be the key in my mind. I'll go through that in just 1 minute, but let's just kind of take a look at where we've been over this past week. You can see here that the markets are fairly steady, fairly quiet. Everybody was up in the green, but again, barely. 1 basis point in the Dow, which is essentially flat. S&P 21 basis points, NASDAQ 69, and then Russell 98 basis points, slightly under a percent for the Russell. Year to date, everybody's solidly in the green. And then, of course, if you look at the best and worst performers, pretty little wide dispersion. Energy also having an ugly week, 3.5% down. Discretionary up just slightly under 1%. Year to date, technology and utilities are still bringing up the front and the rear of the markets for this year. All of them, both of them, are very similar, but the damage in the utilities is significant this year. If we look at valuations, you can still, I think in my mind, still fairly rich. PE ratio around a little over 20. Dividend yield 1.5%. 10-year Treasury still a robust 4.25%. Earnings yield about 4.78% in the S&P, which is about 53 basis points higher than the 10-year Treasury. The real yield is still positive, a little over 100 basis points. Current VIX finished the week almost flat from the prior week. It was down 2.22% for the week. Closing out the week at 12.35. You can see the prior week it closed out at 12.63. Either way, we're in the 12 handle, which tells me that the markets are fairly quiet. We've had a lot of sideways action for the past week or so, couple of weeks. The markets are consolidating the gains from that huge momentum that we saw in the month of November, right? This is the third time that the Russell, the small caps, third time in the past 4 weeks that the small cap rut has outperformed the S&P. So that's good because it was a significant underperformance and narrowing the gap between the Russell and the S&P and clearly the NASDAQ over the past month. But we're starting to see some money backfill into the small cap Russell, which is a good thing. Now, also helping the markets this week, we did get the Friday's closely watched non-farm payrolls. It came in 199,000 jobs added. Markets were expecting 180, so a little bit more aggressive than the markets were expecting. Meanwhile, the unemployment rate fell to 3.7 from a 3.9% unemployment rate. So still very robust. That's going to keep the interest rates higher for longer in my mind. The average hourly earnings also rose 40 basis points above expectations, right? Year-over-year increase remained at a consensus 4%, right? The other thing that kind of surprised the markets is the University of Michigan consumer sentiment in December jumped to the highest level we've seen since August, right? A lot of that's due to inflation coming down and calming a little bit, still high, but coming down. The consumer in the vote basically expect prices to increase 3.1% in the coming year, but that's down from 4.5% in November. That's the lowest estimate by this consumer sentiment gauge since March of 2021. Okay. Also, data on the job openings, it kind of drove the continue to decrease, I guess, the long-term interest rates over much of the week. The yield on the 10-year actually hit an intraday low of 4.1% before closing out the week at 4.25, as you can see there on the screen, right? Keep in mind, guys, that the Feds drive near-term interest rates. The back end of the curve is typically driven by market sentiment, consumer expectations, or the market's expectation of long-term growth, and that's coming down. So they could be a good thing or a bad thing, right? But overall, the Feds drive near-term interest rates, which drive earnings forecasts, which in turn drive valuations, which also affects overall market sentiment. So it all leads back to the Fed. And we're going to get that this Wednesday. That is going to be the big event coming up this week. Okay. Now, if we come over and look across the pond, we take a look at Europe. Everybody was in the green, solidly so, except for the FTSE, but everybody's in the green. In fact, if you look at the DAX, they're up 20%, although they didn't do so well from an industrial output perspective. Euro stocks up 19%, CAC 40 up 16, DAX up 20% year to date, all strong for the week. Part of it helping the markets over in Europe, several executive board members on the ECB seem to be shifting to a more dovish stance, basically giving interviews saying that they believe that the recent inflation numbers coming out shows that no further rate increases are going to be likely. Okay. In fact, inflation slowed over in Europe for 3 months in a row to just above the ECB's target of 2%. Right. But like I said, in Germany, ugly. Industrial output fell for a fifth consecutive month in October, sliding, I guess, 40 basis points sequentially, month over month. It was more of a contraction than the 20 basis points that people were expecting. Also, factory orders in Germany unexpectedly slumped, dropping to 3.7%, while the jobless rate in Germany rose to 5.9% in November. It's the highest level they've seen since 2021. And keep in mind, where Germany goes, the rest of Europe's probably going to follow. Now, why is Germany having such an ugly time? But you can see the market's up 20%. There's a little bit of a divergence going on there. One of the reasons is that Germany is a big industrial output country, right? They drive a lot of the exports in autos and manufacturing, industrials, things like that. And the cost of energy is gone up by double because they've cut their energy usage by Russia dramatically, which is where they got a lot of their cheap energy from. And now they're exporting it from other Northern European countries in the U.S. And it's costing them more money. So that's driving a hole in a lot of the income statements of a lot of industrial companies. So that's part of the reason. But that's going to slide over to other countries all across the European nation. So let's just see where that kind of shakes itself out. Now, of course, if we go with the Asian markets, you can see the Nikkei had an ugly week, down 3.36%. Year to date, it's still fairly strong at 23%. China and Hang Seng also in the red. But what drove Japan were basically comments by the Bank of Japan officials increasing the speculation that the central bank's going to abandon its policy of negative interest rates, right? So that kind of weighed on riskier assets all over Japan. And that perceived Bank of Japan hawkishness drove the 10-year yield up to 77 basis points, right? And the GDP in Japan contracted bigger than estimated 2.9% on an annualized basis in the 3 months ending September. And that was compared to an initial reading of 2.1. So news coming out that they're going to slowly stop their huge fiscal stimulus because Japan and China are the only countries now pumping money into the economy. So that, hurt the returns for the week in the Nikkei over in Japan. And of course, China, which Hong Kong or Hang Seng Index is a satellite of China right now. Equities fell. It started on Tuesday when Moody's cut its outlook for China's government bonds to negative from stable. All right. And then it's just been going downhill for China. And this just caps off an ugly year. Year to date, China's down 3.87% for the year. Hang Seng well beyond correction territory, almost in a bear market at almost 17.5% to the downside. Okay. The S&P Global Survey of Services showed that it did move above 50 to come in at 51.5, but just barely. However, overseas exports, it did rise up above consensus at 50 basis points, but that's going to Europe and the U.S. But and it had a decline of 6.4% the previous month. But imports continue to fall 60 basis points in November. That was down from a 3% growth the prior month. So China is in a funk, and they're trying to consolidate, and they're putting a lot of stimulus into the Chinese markets. But that's going to slow down the global economy, and it will affect Europe, and then Europe, it'll wash over to our shores as well. All right. So even though we're going to have a strong finish this year, I do believe next year is going to be entirely different script. Um, in the era of higher interest rates, inflation staying up for longer. But like I said, the dot plot is key. Members for our Sunday night session on our weekly market watch, I'll go through a little bit more detail on that. What I want to shift over here, let me just find my cursor here. I'm going to shift over and show you the SPX, which isn't affected really by the rotation of the front month quarterly futures for the S&P out to the next quarter. If we look at the markets here, you're going to see in this particular case, it's going to take a couple of seconds to come up on your screen. This is the SPX. And you could see this downdraft, and I had our members prep for it starting the end of July all the way through, and then we finally broke out. You can see this upturn in the 50 EMA in the SPX, right? It's the cash index. This is my target, guys, and this target may not hit until January, maybe early February, and then we're going to pull back. And my target is around 47.08, which is not the all-time high for the SPX, which is up here around 48.12. Okay. And you can see this breakout here. You can see this upsloping trend line that goes back a pretty good ways, right? I mean, if we just break it out and you really look at the detail, you can see this pullback here that we had August, September, and October, and now we're moving up to this next peak right here. This was back over in January 2022, and then this upsloping trend line, which really, and let me just put it on a weekly chart here, just step it out, make it a little bit easier for you to kind of just see how things are lining up here. You can see here from the COVID, and then we had another touch point here, and you could just see how we're riding right up here, the top of this. We're probably going to hit this right up here in January. We're a little over 47.20, somewhere in that area. I don't think at this point we're going to hit 48.12 unless we get an accommodative Fed, right? I don't see that happening. And the dot plot's going to be key. So if we just zoom back in again and we put it back on a daily chart, just to kind of get a little bit more macro here, or micro, you can see how we've been just slowly inching higher, this upsloping trend line right here. We tried to break out here, it failed. We tried to break out here. Again, this is my target right up here. And I got a target time frame that goes all the way out to about the middle of February, right? Right around the 4,700 level for the SPX, okay? And then after that, again, not the all-time highs, we're going to come back into this support resistance zone where the middle of it is right around anywhere from the upper boundary of around 46 down to the lower boundary of around 45.50, right in that area there. But we got to first get through this process here, okay? And then, of course, if we look at the other indexes, they're very similar, but I wanted to show you the Russell here. And you can just see the fast movement. I'm going to shift my screen now again. And let me get you over to this screen right here. It's going to take another 10 seconds, I guess, to paint on your window there. And you're going to see here that the Russell, it was in the red intraday as late as the middle of November. So just a few weeks later, and then here we are sitting here like this. This is a good sign. The MACD's not showing divergence. That suggests that folks are coming in and we're starting to get a little bit more breadth in the chart. And speaking of breadth, if we look at the ratio of equal weight to the S&P, you can see here how this has been moving up. That means that the equal weight assets are moving better, or on a percentage basis, better than the those stocks that have a higher market cap, right? And of course, if we look at the Magnificent Seven, you're going to see right here where it's been pulling back actually since right around the beginning of December, and it's just now starting to come back up a little bit, right? So that's something that is important that I want to see. Same thing with the FANG index. The FANG index has also been pulling back and then just coming back a little bit right here like this to give us kind of a setting up for a final blowout through the last couple of weeks of the year. But the Feds can screw that up with their dot plot, which essentially all 12 voting members vote where they see interest rates in each of the Fed meetings going through the end of 2024. And as a reminder, they came out with just 2 interest rate cuts in 2024. The markets currently expect 4, some expect 5. So there's going to be a divergence there, and that could have a propensity to drive the markets a little bit lower, right? And you could see here, if we look at the VIX, it is at 12.35. We haven't been down this low, right at this level here, in a long, long time. If I just go back on the chart and really just move it back, well, let's put it on a weekly, make it a little bit easier here. If we look at a weekly chart, you can see here, it's a little bit messy here, but let me just kind of zip out a little bit. You can see right here, we haven't been this low really since right around 2019. And when you get down this low, the odds favor a jack higher in vol. Puts are very cheap right now. And I'm telling our members that don't have position structures with built-in hedges should look at Q1 puts, out of the money puts as a potential hedge in the markets, right? And then, of course, if we look at treasuries, if we look at the bond market, you can see the bond market had a huge down day, which meant coming down here, interest rates were up, and we're back off these 2023 lows right here. And you can see we're still in the red for the year. That was the 2022 close, but we're moving up very strong, right? Which then would suggest interest rates are coming back down here. Look at these rates. We came down below the 200 EMA. We moved back up. I suspect we'll probably run up and challenge the 50 EMA again in a kind of a contrarian move. Run into some resistance here around 4.5. But all of this is going to depend on what the Fed say in their dot plot. It's going to be really important. The dollar had a strong day. Interest rates, you can see here we're back into the green again. You can see the 15 to 200 starting to parallel railroad track it. So it's going to have a hard time getting over that level. It all depends on where the Feds go on Wednesday of this coming week. That's going to be the kicker for this. And of course, if we look at the euro, same thing. Euro, I like being long on, but this is a buy the dip in the euro. We're starting to find support right here. Could be setting up for potential long. And then the Japanese yen, members, I'll go through some trades here with you, but look at this. I mean, I've been talking about this for months now, being long the yen, right? It's a low-hanging fruit trade. You want to take the trade. And then the best way to do it are some of the strategies I've pointed out to you. And we'll go through it again Sunday evening in our weekly market watch. Then, of course, if we look at gold, you can see gold intraday really blew it out. You can see intraday it had an all-time high on, and it wasn't December the 1st. What date was that? I think that was December the 4th. So let me just change that. I'll update that on my screen here. But on December the 4th, it moved up dramatically, right? I mean, and then it pulled back just as quickly. That told me that there were a lot of positions taken out, a lot of people shorting the markets right up at this level here, expecting gold to go down. And then you could see that intraday move up here, 17.61%. And then it came back down just as dramatically. A little bit of a bearish divergence fired off right here. I think a little bit of a settling in here before we get to the Fed. So the Fed's are going to be driving just about everything here, except for oil. OPEC is trying to drive oil, but OPEC's not having a good go of it. Look at oil. It hit our target almost to the T right up here around 95, and away we go to the downside. We got a cross in the 15 to 200. That's considered a death cross. This is a bear market chart now where every rally should be sold. That tells me that the economy is not going to fare as well going into the middle to end of 2024. Typically, oil starts to sniff out potential recessionary environments here, which also may be reason why gold has taken off as much as it has. Also because of the deficit, the budget crisis here in the U.S. and the amount of deficit that we're running right now is the largest the U.S. has ever experienced. So I think the cost of funding that deficit is going to get more and more expensive for the U.S. So it could be being sniffed out by both gold and oil. We'll see over time, but that's a little bit about what I'm seeing here. Members, For our weekly market watch Sunday evening at 8 p.m., we'll go into more detail and take a look at some trade opportunities for everybody. All right, everybody, have a great weekend. See you guys later. Ciao now.